Welcome. Today, we're going to demystify financial derivatives. Now, that might sound like a really intimidating topic, but it's actually a powerful tool that's used by pretty much everyone, from farmers all the way up to the biggest corporations. So, let's just start with a fundamental question. Whether you're a farmer, an investor, or you're running a massive company, how do you deal with the fact that you have no idea what prices are going to be tomorrow? That's the challenge we're going to tackle. And to make this real, let's tell a story. Picture a farmer in Punjab. He spends all year growing wheat, but his big problem is simple. If the price of wheat suddenly crashes right before harvest, his entire year's profit could just disappear. It's a huge risk. So what can he do about it? Let's dive in. We're going to break this down into 5 simple parts. We'll start with the basics and then build our way up to see how our farmer, and really the entire financial world, deals with all this uncertainty. Okay, so first things first. What exactly is this tool that can help our farmer and so many others? Let's get a clear definition. And here is the absolute key. A derivative's value is derived from something else, an underlying asset. By itself, it's just a piece of paper, a contract. Its value depends entirely on the price of wheat, or a stock, or maybe even a currency. All right, so that's the theory. Now let's get practical and see how this abstract idea gives our farmer a very real solution to his problem. This is what's called a forward contract, and it's the simplest kind of derivative out there. It's basically a private deal, a handshake agreement. The farmer agrees to sell his wheat, say 3 months from now, at a price they decide on today. It's amazing for him because he's just eliminated the risk of the price dropping. Now the catch? He also gives up the chance to make a killing if the price suddenly skyrockets. He's trading that upside for certainty. You know, forward contracts are great, but they're not perfect. Because they're private deals, they can be really inflexible, and you have to trust the other person to actually pay up. The market needed something better, something more standardized and reliable, and that's where futures contracts come in. This table really nails the key differences. Futures are traded on an organized exchange, so everything is standardized, the contract size, the dates, which makes them super easy to buy and sell. But the real game changer here is the daily settlement, what they call marking to market. Every single day, your account is updated with your gains or losses. This drastically reduces the risk that someone's going to default on the deal.
But what if our farmer wants the best of both worlds? What if he wants protection if prices fall, but he still wants to be able to cash in if prices shoot through the roof? Is there a way to do that? You bet there is, and it's called an option.
This is where options enter the picture, and they work in a totally different way. Instead of locking you into a price, they give you something much more valuable: flexibility. And this is the whole shebang right here. An option gives you the right to do something, but not the obligation. Think about that. You pay a little fee up front, it's called a premium, just for the choice. If the market moves in your favor, great, you exercise your right. But if it goes against you, you can just walk away, and all you've lost is that small premium you paid. It's powerful stuff. And options really boil down to 2 basic types. You've got your call option, which gives you the right to buy. You'd want this if you're an optimist, if you think the price is going to go up. Then there's the put option. This gives you the right to sell. This is your tool if you're a pessimist and you think the price is headed down. So now we know what these different tools are. The next logical question is, why do people actually use them? Well, it turns out there are 2 very different, almost opposite reasons. On one side, you have the hedgers. Think of them as people buying insurance. Our farmer is a perfect example of a hedger. He's using a derivative to reduce his risk. But on the other side of that coin, you have the speculators. These folks aren't trying to reduce risk, they're taking it on. They're using derivatives to make a bet on where they think prices are headed, often using leverage to make that bet much, much bigger. And that brings us to leverage. It's a huge part of the story. With just a small initial deposit, a speculator can control a massive position. In one of the examples from our source material, a speculator made a 100% return on his deposit from just a tiny price movement. But, and this is a big but, this power is a double-edged sword. A tiny move against him could have wiped out his entire investment and then some. This all begs a really important question. How on earth are these things priced? Where does the value of a futures contract come from? It's actually not just a wild guess. There's a logic to it. A lot of it comes down to something called the cost of carry model. The basic idea is that a future price should be today's price, the spot price. plus all the costs of just holding on to that asset until the future date. Think storage fees or the interest on the money you use to buy it. Then you subtract any income you'd get from it, like dividends from a stock. But what happens when the market gets it wrong? When the actual price of a futures contract drifts away from what this fair value should be? Well, that's when things get really interesting, because it creates an opportunity for some very sharp traders to make a completely risk-free profit. This is called arbitrage, and it's the market's self-correcting mechanism. Here's how it plays out. A trader spots that an ACC futures contract is way overpriced at 230 rupees. So they borrow money to buy the actual stock at 220, and at the exact same time, they sell that overpriced future. Then they just hold the stock, collect the dividend, and at the end, they deliver the stock to settle the futures contract. After they repay their loan and interest, what's left over is a guaranteed risk-free profit. And when enough people do this, it forces the futures price right back where it's supposed to be. Okay, so let's tie this all together. What are the big things to remember? First, derivatives get their value from something else. Second, forwards and futures are all about locking in a price. Third, options give you that incredible flexibility, the right, but not the obligation. Fourth, these tools have two faces: hedging, which is about reducing risk, and speculating, which is about taking on risk to seek profit. And finally, the magic of arbitrage is what keeps the whole system priced fairly. So we're left with this huge question. Are derivatives essential tools that make our modern economy possible, or are they just dangerous instruments for high-stakes financial gambling? The truth is, they're both. They're absolutely vital for businesses to manage real-world risks, but that same power makes them incredibly potent for speculation. And understanding that duality, that's really the key to understanding modern finance.